Hi, everybody. Welcome to the Origin Exchange Launch webinar. I'm Michael Episcope, co-CEO of Origin Investments, and we're going to give it maybe another minute while people are trickling in here. And in the meantime, I'm going to scroll through these disclaimers. It's part of our legal compliance. So thank you for joining. We have quite a bit of interest in this subject. I just heard that there are about 950 people who registered for today's webinar. We already have about close to 200 people joining us live. So thank you all for joining us and tuning in today. The purpose of today's webinar is to introduce you to our newest arm, the Origin Exchange. We are going to give you an overview of the program today, educate you about the market, and answer any questions you may have. Joining me today is Mike O'Shea. He is our Vice President of Origin Exchange. Mike is our in-house 1031 exchange expert, and I will formally introduce him in about 10 minutes. We are not going to be covering any specific deal today. We do expect to have a deal in the next 30 days tied up, and when we do, we will host a separate webinar once that deal has a certainty of closing. I'm going to cover about Origin today, and then to give you a brief overview of the program, and then Mike is going to dive into the specific details. We should be done with the webinar slide presentation in about 45 minutes or less, our portion of the slide presentation, and then we're going to open it up for Q&A afterwards. Thank you for your questions in advance. We got quite a few of them. They really help shape the webinar. We're here to answer your questions. And if you have more questions along the way, please put them into, excuse me, the question and answer box, and we will get to them immediately after our portion is done. I'm super excited to be hosting this webinar today. This has really been years in the making. Dave Shear, my partner, and I, we have been talking about this in some form or fashion for, it has to be at least the last 5 years. And the reason we didn't launch it sooner is simply because we prioritized other initiatives at Origin. We launched the Income Plus Fund, we launched QOZ funds, multifamily credit funds, strategic credit fund. So a lot going on at Origin, but this is sort of the last piece of the puzzle. And there are really two main reasons why we are launching Origin Exchange today. And I would say the very first one is because of demand. We get requests for 1031 exchange opportunities on a daily basis from our investment community. These include individual investors, clients of RIAs, directly from registered investment advisors as well. And I would say this year alone, we have gotten more than $200 million in inquiries. The second reason, which is really more important, is there is a need for a better product in the marketplace. The 1031 exchange market, many of you are aware of this. It has historically been dominated by high fee platforms that invest in what I would characterize as mid to low grade real estate projects, and their track records are not great, and they're really built like fee machines. For me, this is also personal, why I want to go into this market. I've seen firsthand how it operates. 20 years ago, when my grandfather passed away, he actually left my mother a piece of real estate, and she decided to sell it and go into a 1031 exchange. And despite me strongly suggesting that she pay the taxes, they were only 15% at that time, a broker convinced her to do a 1031 exchange into an office park in California. Well, that investment ultimately went to zero and really impacted her life. It was a tough time for her. And the real issue was this was 60% of her wealth. She had no business going in, putting all of that into a single asset. And she was 70 years old at the time. She's still alive today. If you're watching, Mom, hi. She watches a lot of our webinars as well. I think what frustrated me most about the situation, though, is that the broker had no fiduciary responsibility to my mom whatsoever. He put her into an asset that wasn't suitable. He most likely didn't really know anything about the risk of the asset, but he walked away making probably about, a 7 or 8% commission. And when I looked at the deal and really dug into it many years later, she would have never made money. The asset had nearly a 20% load. So any tax savings were essentially wiped out by fees. And that certainly wasn't listed on the front page of the brochure. And this market is anything but transparent. Our lens as an organization is very different. It is to protect and grow the wealth of our investment partners. And don't get me wrong, we want people to make money, and we certainly aren't doing this for free. But our first lens is really about creating a product that can deliver benefits to the investor. We're getting into this market because we can provide a better option than what is out there. And we are going to do this by offering high quality investment options and charge a fraction of the fees. I'm going to jump into About Origin. Many of you on the call today are current investment partners who have some familiarity with us. So I'm going to just maybe briefly go over this. My partner, Dave Shear, and I, we formed Origin in 2007. I'm happy to say we've been friends since 2002. We actually made our wealth in very different industries and when we were a lot younger, and I had much more hair at that time too. When you amass wealth, especially at a young age, your first job is really not to lose it, to protect it, to grow it. And that's your second job, is to make it work for you. And there's really no other asset class that's better at growing wealth and delivering passive income than real estate. And that's really what attracted us to this industry and why we wanted to put a significant amount of our wealth into this area. The reason why we started Origin is because we invested with others and saw how sponsors manage risk, how they charge fees, and we learned a lot through that process, both good and bad. And I think at the heart of what we do really, really well is risk management and making sure that we're adhering to that first tenet of protecting capital in everything we do. What we decided at that time, though, is that we could do it better. And those simple words, we can do this better, started Origin. And we wanted to be in control of our own destiny. In the early days, it was more like family office. It was Dave and I investing our own capital. We had no grand vision. All we wanted to do is do great deals. And the company grew organically. We added investors when we syndicated some deals. We hired people. And most importantly, we delivered great returns and customer service. And that cycle repeated itself over and over and over for the last 15, 16 years to get us where we are today. And I'm very proud of our team, what we've built, how we've been able to deliver our product. We manage more than $2 billion of equity on behalf of close to 3,800 investors, maybe a little more than that today. And we also work with more than 80 registered investment advisors. Our products are direct to consumer. We don't pay brokers. We don't pay advisors commissions to sell our products. We have a saying that good products are bought, not sold. And that's the same thing with this 1031 exchange product. We have 5 offices spread across the country. I'm located in Chicago. This is our headquarters. We actually do not invest here. We're kind of Sunbelt. You can see those other markets across the way and our cities. Those dots are where our offices are. And we have team members who wake up every day thinking about 2 things. And specifically, we have about 61 team members, last I checked. But it's really 2 things: delivering returns and delivering exemplary client service. And that's how our organization is designed. In terms of strategy, we are exclusively focused on multifamily. We have 3 strategies. We are what I would call an inch wide and a mile deep in multifamily. And the 3 strategies we develop from the ground up. We acquire core plus and value add assets directly. And we also have a lending arm. So we really see everything out there. And our job is to provide solutions in the market. So if we're working with a joint venture partner and they're not looking for our equity, sometimes we can turn that into a lending opportunity. But our tentacles are out there. Every broker in the country, every owner in our markets knows who we are and that we are a ready, willing, and able buyer. And that really is important when it comes to deal flow in any strategy out there. I used to think that coming from a different industry was a handicap, but now I really see it as a strength. When you have wealth and build a company, you are going to make very different choices than if you run it on a shoestring budget. And we've always taken a long view. We aren't afraid to do things differently. And I think it's one of the reasons why we've been able to attract the talent we've had and outperform the competition over the years. I'm going to cover this next slide and then I'll introduce Mike, but this is a program overview and I'm going to tee up the entire presentation by really providing a high level overview of the program. And Mike is going to go into much, much more details. So if you have questions, those will get answered in kind of the next 25 to 30 minutes by Mike. Our program, it combines the 1031 exchange element, most of you are familiar with that, with a 721 exchange. And here's how it works. Let's say you own an office building or a warehouse facility or some other piece of real estate and you are no longer interested in managing it or owning it directly and you want to go into more of a passive investment with a manager. Well, you can sell that asset and you can defer those taxes by investing those proceeds into one of our properties purchased and managed by Origin. Now, the legal structure that allows this to happen is a Delaware statutory trust, or known as a DST. The DST allows us as the manager to aggregate 1031 capital from multiple investors. And the advantage of this is that we can accommodate 1031 proceeds, whether you've got $100,000 or $25 million, we can accommodate all that and everything in between and aggregate that into a single asset. As an investor, you own this asset, you will receive the tax benefits that are afforded underneath the 1031 exchange program. You will also receive cash flow and appreciation during the hold period. The next stage in this program is the 721 exchange, and this is known as the UPREIT stage. Our Income Plus fund, it has a right of first refusal on this asset. Now, this is an option, I want to be clear about that, and not an obligation. And we cannot say with certainty that the Income Plus fund is going to buy this asset. But when we acquire an asset for this program, we look at it through the lens of the Income Plus fund to make sure it fits within the fund's strategy. Assuming the fund exercises its option after the seasoning period, the fund would buy the asset at fair market value, and the investor would then receive units in the Income Plus fund, exchange their DST units for operating units in the Income Plus fund. And so when you think about what the investor has done, you've gone from a warehouse or an office building into an institutional grade multifamily, a single asset, and then ultimately into a diversified fund. And the Income Plus fund, it delivers all the benefits you would expect from real estate, cash flow, appreciation, tax benefits. And I do want to point out one bit of clarity in this process. There is no option to receive cash if and when the fund purchases the asset. That would only happen if the fund didn't purchase the asset and then we sold it, you would receive proceeds and you would be able to roll those again. When you go into the Delaware Statutory Trust, you have to be prepared to ultimately end up in the fund. And one of the biggest benefits of this program for many people is it's a lot easier from an estate planning standpoint to split up shares of a fund rather than leaving your heirs with physical real estate. And you can say that for a lot of people, it might not be for estate planning, but for many people, they just want to simplify their lives and get out of managing real estate directly and stop swapping in 1031 exchanges, paying exorbitant fees, but then go into a fund that's actively managed by a professional manager. Quality assets and simplifying your life. Those are really the two tenets of the fund. I'm going to introduce Mike and hand it over to him. Mike is the second Mike. I'm the next Michael, so we're getting a little confusing at Origin and a lot of us running around. But he is our in-house 1031 exchange expert. He's been in the business for nearly 20 years, and he's worked at all of the big shops. He's seen firsthand how the world operates. He is an absolute wealth of knowledge. He knows where all the bodies are buried, so to say, in the market. And he is a great asset to Origin. When we started talking to Mike, I think it was a couple of years ago, known him for much longer than that, but about launching 1031 at Origin, and we shared our vision about what it would look like, he really jumped at it. And we talked about why it would be successful and how it would operate and how it would, be different than what's in the market. And he was not only on board, but embraced it as a necessary change in the environment. And so, Mike was on board right away. And when I called a few of his IRA contacts in the world, people who he had been working with and brokers, they said things like, he's incredibly smart. He knows the ins and outs of the deals. There's no one I've dealt with who's anything like him in this business. And he just understood the details down to the pro forma and everything in the PPM. They said he's straight with us, and he let us know when he doesn't think it's a good deal, and he has our best interest in mind. So to me, that really meant a lot, and I know it did to David too, as well, about him being a cultural fit, and that he believed and believes in what we believe in. And Mike, I would say, was really caught in the wrong system for many, many years. But we are excited to have you here, Mike, and I'm excited to introduce you to the Origin community.
Well, that's great. Thank you, Michael. Appreciate that kind introduction. And I've a similar story. I've admired Origin from the outside looking in for many, many years. And I've said it a few times already, after working here for a short period of time and having a hand in getting this Origin Exchange launch off the ground, I admire the company even more. I think we're putting investors first. And especially, as Michael alluded to, with the DST market in particular, the 1031 exchange market, there's a lot of hidden fees that investors aren't aware of. I think this market is ready to be disrupted. I think that it's ready for a better product. And so I'm really excited to launch the Origin Exchange platform today. Michael did a really good job on the overview, sort of talking generally what we're going to do. I'm going to take what he said and sort of unpack it. I also think it would be wise to spend a little bit of time on education. And there's some people on this call, as we get the attendee list well ahead of time, there's some people on this call that have been working on 1031 exchanges for 20 or 30 years. I'm sure there's some people on this call that don't know what a 1031 exchange is, and they just want to learn a little bit. So we'll talk about the rules of the road, we'll talk about the time frames, and we'll get some education done. And then we'll talk a lot about how we perceive the market and how we can go back to protecting your wealth and simplifying your life while avoiding taxes. And I think Origin Exchange is going to do that for you. When we looked at the DST market in general, there was quite a few fees that, as Michael alluded to, were egregious. But I think more than being high fee type products, the real challenge with the DST market is that the fees were hidden. And so the clients put $1 million into a DST. Little did they know that $800,000 is going to buy real estate and $200,000 is just gone in fees. And so we wanted to do it better. And so we'll dig into that. We're obviously going to do Q&A at the end, but I would also point out, I'm actually seeing quite a few come through as I talk. You can book a meeting with me directly. So if you've got a property under contract, if you've got money with a qualified intermediary, if you're thinking of selling and you just want to know what your tax liability would be, use that booking link that's over on the right-hand side, and you could schedule a 30-minute call with me, and we'll just do some discovery. One quick story I wanted to relate as we get into talking about, one-on-one meetings and specific cases is that typically when you're talking about financial services world and lowering fees for investors, more alignment of interest, better investment outcomes for our investors, that's super important. But what's always enamored me with the 1031 exchange space is how we're actually improving the lives of our clients. And in a lot of cases, improving their overall level of happiness. And I'll just give you a quick example. A few years ago, probably 5 or 6 years ago, I was working with a family out of Chicago in Arlington Heights, just outside. and they had a multifamily property that she had inherited from her father. And so she never meant to be a real estate investor. She was running this property for many, many years, and it had sort of fallen into disrepair. So normally I do discovery because I want to know, would you be better off selling that property? Would you be better off keeping the property? Or would you be better off with us doing a 1031 through a DST? And so I just started asking, what is the property cash flowing? What are your property level expenses? How much time are you spending on this? And during the questioning, she just broke down in tears. And it was just eating away at her that she felt like she was disappointing her family, not running it well. And it was just this huge stress point. And so at that particular time, we had a DST offering that was like an $80 million apartment complex in Atlanta, Georgia, I think. And so I said, well, here's the concept. What if you sold it? What if you rolled the proceeds into this property in Atlanta, and now you own 1% of an institutional quality asset instead of owning 100% of this asset in Arlington Heights? We'll send you a monthly paycheck. We'll manage the property for you. And you can eliminate the 3 T's, as people that manage their own real estate know: the toilets, the trash, the tenants, the nonstop phone calls. Managing real estate is hard. And I think her initial reaction was, that sounds a little too good to be true. I don't believe it. It was a long conversation. At the end of the conversation, there was more tears and hugs. And she ended up doing the deal. They sold the property. They invested into this DST, and it was a big improvement in their quality of life and happiness. And by the way, a raise. I think that was kicking off somewhere around $35,000 to $40,000 of income annually, when the property that they currently owned was not kicking off much, if any. So just wanted to get that story across, as that's a very important part of this, is to unwind yourself from the day-to-day active management of real estate. All right, so getting into the educational portion, I think it's, people say, what is 1031? This is Section 1031 of the IRS tax code. That's where we get the name from. This has been on the books for over 100 years. 1921, it was the Starker case, where basically was selling farm ground and said, if I buy new farm ground, that shouldn't be seen as a sale and a subsequent purchase. That should be seen as an exchange of assets, and therefore no taxable event has happened. So you may have actually heard these referred to as a Starker exchange in the past. That would be the same as a 1031. And it relates to investment property. If you sell real property that's held for investment purposes, and if you exchange it for the same within a 180-day time frame, it's not seen as a sale and a new purchase. Your cost basis rolls over, and you can defer 100% of the taxes due. So Section 1031 is the most powerful tool in the tool belt for real estate investors. And deferring the taxes is an extremely important part, because as you start to think about, what taxes would I pay if I sold this particular property? Well, everybody knows about long-term capital gains, and that's usually the estimate that people use. We've got a quick example here of somebody selling a property versus doing an exchange. And you notice the original purchase price is $600, you sell it for 1.2. And so a lot of people would say, well, I owe $120,000 of capital gains tax. One of the best benefits of owning real estate is depreciation, where you can offset your income. But remember, when you sell the real estate, you have to recapture all the depreciation that you've accumulated. And that's at an even higher rate, 25%. Depending on the state you live in, California is as high as 13%, New York, Minnesota, Washington, Iowa, all very high tax states. That could be another 10, 11, 12%, but about 6% on average across the country. And then net investment income tax, which is 3.8% of income over $250,000. So you see in this quick example, you actually have $307,000 tax liability on a $1.2 million sale. And if you were able to facilitate a 1031 exchange correctly and defer all of your taxes, you would end up paying zero. So it's actually much more powerful than just deferring the capital gains tax at the federal level. You get to defer all state, local, and federal taxes in a 1031 exchange. Now, one of the things I've noticed over the years is that people tend to forget what they paid for the property, how much depreciation they have. And so we've created a handy calculator. This is on our website. You can enter in what you paid for the property, what you sold it for, etc. And what's really nice about our calculator is there's going to be a little button on the bottom that says email me a summary. And so it's going to send you a PDF file, and it's going to have all of the numbers you inputted plus your estimated taxes. And so you can print that out, you can keep it with you in a folder, and as you work through your 1031 exchange process, those numbers will always be handy. So I hope that's valuable to you. And of course, it's just an estimate. If you want to know the actual taxes you'd pay, you'd have to consult a qualified tax professional, but at least this would give you an estimate of what your taxes would pay. This is a QR code. I'll give you another second here. If you'd like to access this at any time, you can feel free to open up your phone, use the QR code, and that'll take you directly to our calculator as well. All right, so I mentioned there's quite a few rules to the road on a 1031 exchange. So because it is such a powerful tool for deferring taxes, they have set up quite a few roadblocks in order to get a 1031 exchange done. So think about this timeline as when you do a 1031 exchange, there's two closings. You sell your original property, and then you're going to close on a second property. Okay, so that's the relinquished property and the replacement property. Day zero would be when you sell your property. From the time you sell, you have 45 days to identify a replacement property. And that's just identifying the address. It's a farm at this address or whatever. You can identify up to 3 replacement properties. That's actually a really important part of this timeline, because once you're out of that 45 days, you can only close on what you've identified. So let's just say, for example, you identify a property at 123 Main Street. Now you're out of your 45-day window, and for whatever reason that property falls through, you've just blown your exchange. So you can identify up to 3 properties. Our suggestion is to always use them all as backup. And then, of course, you'd have to complete the exchange, close on the subsequent property within 180 days. All right, so that's the timeline. That's what everybody's kind of familiar with on a 1031 exchange. But there's actually a couple other rules to follow as well. First of all, the properties have to be kind to each other. The good news is this doesn't mean that the properties have to be, if you sell a hotel, I have to buy a hotel. If I sell raw land, I have to buy raw land. That would be very, very difficult. Luckily, that's not what this means. It just means real property held for investment purposes for the same. So sell multifamily properties, you could roll it into vacant land. You sell vacant land, and you could roll it into a tenant in common interest. And so you'll notice two towards the bottom. One is a TIC interest. One is a Delaware statutory trust. As Michael alluded to, we will talk about those quite a bit more later in the presentation. So what doesn't count? Shares of REIT stock. Interest in real estate funds. That is not real property. Those are securities. Collectibles, personal property, those used to qualify for Section 1031. The Tax Cuts and Jobs Act of 2017 actually stripped that out. So you can no longer 1031 exchange personal property. However, just as a side note, if you do have capital gains in any of the assets that don't qualify for a 1031, an opportunity zone fund might make sense for you, which is also a product that Origin offers. So if you're selling a business, or if your NVIDIA stock is up through the roof, and you've got capital gains and you want to eliminate some of those, an opportunity zone fund might make sense. And so we can talk about that on another webinar, or if you want to schedule a call. The second requirement is that you can never take constructive receipt of the proceeds. And so you have to use an escrow agent. So the escrow agents are referred to as qualified intermediaries or exchange accommodators, typically just called a QI. You'll hear that quite a bit. And so if you think about it, the taxpayer is there in the middle. You've sold your property on day zero. That's the disposition of original property. The sales proceeds are wired directly to the qualified intermediary. You will identify your 3 properties with them, and then you will go to close on your replacement property over that 180-day window. They will actually wire the cash directly to the closing table. And so you've never touched the proceeds during this entire 180-day process. If you don't know any qualified intermediaries, or if you want some referrals, we work with some very, very competent qualified intermediaries. We'd be happy to pass along some names to you. Another one that comes up quite often is the same investor, same entity. So Real estate's typically held in LLCs and partnerships. And so you see this is ABC LLC. They are selling real estate, and member A might come to me and say, can I do a 1031 exchange with my portion and my partners want to cash out? The answer is no. The LLC would have to do the 1031 exchange. So you need continuity of title. Don't worry, this is so common. There's a lot of solutions for this. You can do a partial exchange. You can do a drop and swap. In fact, the platform that we're putting forward, a 721 UPREIT solution, can solve this problem as well, wherein ABC LLC does the exchange. Eventually, you get upreited into a broadly diversified portfolio. And at that point, you can retitle it because it's not real property, it is a security. And so we've got multiple solutions. If you're in this case, feel free to use my booking link over on the right-hand side and schedule a call. We can talk about it. The last three all sort of rhyme with each other, so I'll just do them together. Replace mortgage debt, purchase price matters, must roll over 100% of the equity. The easiest way to think about this is if you sell $1 million building, you have to replace it with at least $1 million replacement property or more. You can always go up, you just can't go down. You also have to roll over 100% of your equity. So this is an and clause. It's not either. So think about it this way. If you ever take any cash from the sale of a property, it's going to be taxed. So the money from the sale has to go to a qualified intermediary, and it has to all go to a 1031 replacement property. Otherwise, there's tax. So I'll walk you through just a couple examples here. So remember, you have to do both. And so I'm giving an example of how somebody would have violated this in either instance. Okay, so same example on the left-hand side. You sell a property for $1 million. You're 40% loan to value. So at closing, you pay off the loan of $400,000 and you have $600,000 in your pocket. And on the example one, this investor finds a replacement property that's $1.25 million. And he goes to a bank and he finds out he can secure 60% leverage. So he just does the backwards math and says, well, I only have to put in $500,000 of my proceeds. I'll put in $500,000, I'll borrow $750,000, I'll buy $1.25 million, and I won't pay any taxes. Well, because this cash, your $600,000, you only put $500 in the deal and you kept $100, that's actually going to be a tax liability for you. Opposite example, somebody takes all of their cash from the sale. So same numbers on the left-hand side. Sold $1 million property, paid off your debt, $600,000 in your pocket, and you roll that over into an all-cash deal with no leverage. So you've gone from $1 million of real estate and you've gone down to 600. So even though you've rolled all of your cash, this is going to be a taxable event for you. So this is something that we can and will help you with if you need to replace the full value of your property. If you need debt to get up to that level of replacement, the Origin Exchange platform can help you do that. Okay. So Michael alluded to DSTs a little bit earlier. We have a full revenue ruling on this. It's 2004-86, and it basically states that an interest in a Delaware statutory trust will qualify as like-kind for the purposes of an exchange. And so the purpose for this is to exchange up into a higher quality piece of property and exchange out of the day-to-day management. We are pooling our capital together, and we are buying an institutional asset that we otherwise wouldn't be in the market for. And so just a couple examples. This is, part of our portfolio. Many people on the call are already investors with Origin. You're probably familiar with these properties. Many people are relatively new. So we are not talking about a specific property on this particular presentation. We will be going to market soon with one, but just sort of an example to kind of give you the institutional size, scope, quality of the properties that are considered in the DST space. So when we looked at the DST market, there was nothing wrong with investing in a DST. The problem was the structure. The problem was this part of the market was taking investors' capital and putting a tremendous amount of fees on the front end. And it's hard to grow your wealth when you're paying fees, especially if you are unaware that those fees are there. So just for an example, I just wanted to point out, this is not any particular company in general. This is just an average of all the companies that I've been doing research on that are in the DST market. If you look at selling commissions, broker-dealer fees, finance coordination fees, disposition fees, asset management fees, and the list can go on and on. This is not exhaustive. You can get a load on your investment up to 20%. 20% is high, probably more like 14, 15, 16%, which is still incredibly hard to overcome during the DST period and make money. So again, with Origin and putting investors first, this is the first thing we checked off the list. We are not going to be taking any of these fees. We are going to put more of the investors' capital into real estate. And we think that's one of the best pathways to generate long-term wealth, not paying these transactional fees. So just a quick, side by side, we are, taking some fees. It's important for us to charge and earn revenue. And so, we've looked at what's important for us. Well, we put the deal together. We've got deal teams out in the market underwriting deals. And, for structuring purposes and things, we do charge an acquisition fee to put a property together. There's also O&O expenses. You can think of these as third-party reimbursements, where essentially, legal fees, traveling, meeting with investors, all of that is kind of added up, which we're still contemplating the fees. We'll have this, locked down by the first, deal that we have out in the market. But, you could see our average load would be somewhere in the 1.5% to 2.5% range compared to mid-teens on average. So we've significantly cut that fee load. And like I said, we are planning to disrupt this market and hopefully be the preferred choice by putting more of your capital into the ground. So that's a quick summary on Section 1031 of the tax code. Most people are very familiar with that. Most people that I've spoken to have not heard of Section 721. And Section 721, some people will call it an UPREIT. That stands for Umbrella Partnership Real Estate Investment Trust. And it's sort of become synonymous with a 721. So if you hear somebody say UPREIT, they mean a Section 721. And essentially, if you contribute real property to a partnership and you don't get cash, you get partnership interest in exchange, that transaction can be 100% tax deferred under Section 721. So this appeals mostly to institutional investors that own significant assets that would sell them to REITs. And so I want to sell this to a big REIT. Now the REIT gives me, I sell a $50 million property. Now I get $50 million worth of the operating partnership of this REIT. And now I'm diversified away from this asset and I have exposure to all of these assets. Now, most of our investors don't own assets that the Income Plus fund would typically acquire. Our investors own floor flats and they own vacant land and they own farms. And it's been an interesting time. I've had a lot of calls with a lot of investors and it runs the gamut, right? But these are not assets that we would put in the Income Plus fund. And so we can't do a direct 721. We can't buy your asset from you with operating partnership units. So we think this is a pretty elegant solution that if the fair market value option is exercised by the Income Plus fund, could eventually lead to that same endpoint. So Michael already went over this. I won't belabor the point. You sell your property. The first thing you do is a 1031 exchange. You'd have to follow all of those rules. The money goes to a qualified intermediary and eventually gets rolled into a DST syndicated by Origin. You will hold that DST for 2 years. During that 2-year period, you'll receive all of the income. You'll get the depreciation benefits. You'll get any appreciation benefits if the asset goes up in value. You will be an owner of that asset. After 2 years, the Income Plus fund has an option to acquire the DST. When it acquires the DST, it will use operating partnership units as consideration instead of cash. And so that will be under Section 721 of the tax code. And so the benefit there is you get to continue your tax deferral. So sell your property into a 1031, into a 721, still haven't paid any taxes. We're going to continue to generate passive income. Our Income Plus fund, which I'll talk about in a little bit, a a little bit more thoroughly is kicking off, I think 6.25 on the distribution right now. And then enhanced liquidity. So this should always be capital that you want to keep invested for the very long term, but should you need access to your capital, the Income Plus Fund has a redemption schedule wherein you can repurchase back some of your some of your operating partnership units or all of them. And so this is more liquidity than just owning typical real estate out in the marketplace. And Michael touched on this in the beginning of his presentation, estate planning. This is so powerful. It kind of goes back to my story with the Arlington Heights family. This really cleans up an estate from, I don't want to burden my family with this real estate. Who's going to manage it when I die? Are my heirs going to fight over this? And so this is a way that you can roll it up into a security, easily divisible, and then your beneficiaries would still get that same stepped up cost basis when they inherit it. And then finally, I think the biggest one is diversification. So think about it like instead of owning Microsoft stock, now you own a tech mutual fund. And we are diversifying you away from that single asset risk and what could happen to this one asset. Now your risk is diversified across a larger portfolio of institutional assets. And most of the investors that I talk to at their phase of the investment life cycle are much more concerned with preservation of capital and de-risking their portfolio. And I think that's exactly what this platform is built to do. Okay, I mentioned we would get into frictional costs. One of my favorite people to read is Charlie Munger. If you don't know who Charlie Munger is, he is the right-hand man of Berkshire Hathaway. He passed away last year, actually. So he was Warren Buffett's right-hand man. Warren Buffett actually says Charlie Munger ran the company. He's got many, many quotes, many, many thoughts on the market, but this is one that I really enjoy. And it just says the first rule of compounding is to never interrupt it unnecessarily. And that speaks well to the idea that you can make a lot of money in a deal, but when the deal liquidates, you've got to pay a tremendous amount of taxes. And then you go into another deal and you've got transactional fees to get in the next deal. And so keeping your capital invested for the long term while reducing those frictional fees and taxes is one of the best pathways to wealth. And this is what the Origin Exchange platform is built to do. So here's just a quick example. All right, so this compares three scenarios, okay? You sold a property for $1 million. So you could either pay the taxes, that would be the red bar. You could do a typical DST in today's market. And a typical DST in today's market, every 5 years, you roll into another DST and you roll into another DST. And they call that swap until you drop. And that is the estate plan for the typical DST structure. Or you could invest it into an UPREIT where you get into a DST once and then you are in the broader, more diversified fund for the very long term. For the red bar, I just used a 60-40 mix, 8.1% average rate of return, which is from Charles Schwab going back to 1976. That's what the 60-40 portfolio has averaged. And you're also starting out lower because you're paying $300,000 in taxes on day one. So you can see the pay taxes and invested in the market doesn't really come close. But if you compare the 721 to doing the swap till you drop, you would have a 23% increase in wealth after 15 years. And what's so astounding about this chart to me is that if you were that gray bar investor, you've turned your $1 million into $3 million and you haven't paid any taxes. And so you'd be very happy with this investment return. The problem is the fees, you never knew you paid them. And so what we want to do is say there is a better option out there where you can be on that blue bar and you don't have to pay any of those transactional fees all along the way. Keep it invested. And by the way, the gray bar and the blue bar are earning the exact same 10% annualized rate of return, just to keep it apples to apples. The only difference is the gray bar is taking out the fees, and then almost a 70% increase over paying taxes. So we think this is going to be a great option for people that are selling. Now remember, I can't emphasize this enough. This is an option for Income Plus Fund, our flagship real estate fund, to acquire the DST. The Income Plus Fund may or may not acquire the DST, but if they do, and if you get 721 uprated into Income Plus Fund, it's very important to understand this fund, because I like to say, if you're doing this strategy, you're sort of dating the DST, but you're marrying the Income Plus Fund. You will be in it for a long time. And the Income Plus Fund is our flagship fund, which was founded on that premise of keeping invested for the very long term with lower fees. It's a good name. It provides a nice steady stream of income, but also has some appreciation benefits. And what I like about this particular fund, as opposed to some other 721 options that are in the market, is they all typically focus on just core. And so in the last 3 to 4 years, as they raised a lot of capital, those other funds just kept investing and investing and investing. And as interest rates went up, the value of their assets went down. And so if you, a lot of you are investors with Origin already. If you're not, we've got webinars that talk about just the Income Plus Fund on our website. You can go and download those, and plenty of information, just to look at, or we could schedule a call to discuss it. But Origin made the decision not to invest in any common equity in the last 4 years, because we saw the prices getting frothy. We saw interest rates were going to go up. And so we made a tactical shift to lending and a tactical shift to preferred equity. And so that has paid dividends for us. If you look at the returns, you compare Origin's Income Plus Fund to a benchmark. This is the NCREIF Odyssey Index, which is a benchmark of large diversified core real estate funds. And you could see the downside protection there. When interest rates go up, core assets are very sensitive to interest rates. And so you see a 12% drop in the trailing 12, and we're up 2. It's a 14-point delta. And so the idea is, if you're going to be in this fund for the very long term, you want to be in a fund that's able to tactically reposition as the economic environment changes. And then the last thing I would mention is that we have a focus exclusively on multifamily. Multifamily is a need, not a want. And if you look at this, chart here, you'll see that multifamily has tracked amongst the highest return with the lowest risk. And so if you're investing in something for the very long term and you're concerned with tail risk or loss of principal, then look back at 2008 and look at COVID. Multifamily had performed the best during those time periods. And so we think this is the most resilient asset class in commercial real estate. And we think it's going to generate long-term risk-adjusted returns for our investors. So that is the Income Plus Fund quick summary. And so I think we're just about wrapping it up. The idea is we want to put more of your capital to work. We want to take you out of the assets you own and put them into institutional quality property. We're going to focus exclusively on the multifamily sector, which is our core competency, which we think has the most resiliency and downside protection. And then there's a potential 721 option as well for you. So I think those are kind of my prepared comments. I know it's a lot. I've seen a lot of bookings kind of come in as I was talking, so I really appreciate that. You can keep using that link. Feel free to schedule some time, and I think we'll go to Q&A.
Mike, great job. I always learn a lot, listening on this side too. So that's kind of fun to hear everything. We got a lot of good questions, and I'm going to start with question number 1 from Dirk. And he asks if we work directly with financial advisors, registered investment advisors, compensating on that side. And we do. We work with more than 80 investment advisors today and their clients with all of our products. And we have a way of actually allowing sort of what I'll call a fee stream, but it's not at the detriment of investor capital. So it actually is a trailer based on the cash flow of the DST itself. So if you're interested in learning more, we can share that with you. There's some nuances around that, but the shorter answer is we do work with registered investment advisors. The other way is obviously you can charge assets under management from your client. In either way, they're going to understand and know and have to sign off on the fee structure on our side. So thank you for the question, though, Dirk.
Yeah, and I have a question here from Greg Raup, just basically saying, if I have a property sale in the next 5 months, will you have a deal available for me? So I'm glad you asked that question. Just to clarify, We have a deal that we are almost out of due diligence on, and we expect it to be our first DST. We expect to close on it sometime late June, early July, and we will have another webinar in probably late June that will talk specifically about that property. Yeah, and I've got a couple simple ones. How much leverage would be used in the DST? We're anticipating 45 to 50% loan to value on the DST. What happens if the 721 exchange doesn't happen? So we get that question all of the time. I think Michael alluded to it earlier, but if the 721 doesn't happen, we will continue to run the DST as an asset, and you will continue to get the income off of it, and we will eventually sell it to a third-party buyer. We just won't buy it. And in that case, you will get the cash proceeds from the third-party buyer, and you could go and do another 1031 exchange.
Jonathan asks the question, how is the DST valued at the time that the Income Plus Fund acquires it? And that's very easy. It's done at fair market value appraisal basis, Jonathan.
Okay, and taxes due if the fund is sold. So this is a good question. If the upgrade option is taken and you roll into the operating partnership units, if you sell those operating partnership units, that is the point when taxes would be due. If you stay in the operating partnership units, there would be no taxes due.
Let me find a question here. After the fund purchase, what are the liquidity options? Nick asked the question here, after the fund purchases the asset, what are the liquidity options, if at all? The 1031 exchange funds are typically locked for 10 years. Does this program help shorten the lockup? So Nick, the answer is there is a shorter lockup than 10 years, but you would still be subject to the Income Plus Fund lockup period, which we have a 1 year lockout completely where you can't redeem. And then we have declining penalties in each year after of 10, 7.5, 5, and 2.5. You would have liquidity during that period. And the nice thing about exchanging for units in the Income Plus Fund is that if you have 20,000 units in the Income Plus Fund, you can sell 1,000 of them. You can sell 500 of them. You can sell half of them. You don't have to sell them all. It's an all or none. And you get the benefit of a step up in basis at death, just like you would in owning real estate.
Yeah, so I have a question about swap till you drop, and basically saying, is the transaction fees the same every time you do a swap? And it is. It depends on the company you work with. Different DSTs have different fees. And so, remember what we're going through in this presentation is just kind of an example of what's out there in the marketplace. But the problem with the swap till you drop is that you really don't see it. So you put $1 million in, and the property sold for 1.1 million. So, oh good, I made money. And so then I roll into the next deal. So now my statement shows 1.1 million. If you had to calculate a net asset value, it'd be well below $1 million because all those fees are gone. And they are disclosed in the 200-page prospectus, but the clients are usually not too aware of it. So yes, you pay those fees every time you do a swap typically.
Yeah, Mike, if I could touch on that, one thing I've learned in just doing the due diligence here and understanding is that a lot of these other firms who we're competing against out there, they market yield and yield alone, and they're not marketing total return. So a lot of investors, unfortunately, are just looking at what is my income. Well, your income is one component of your return, but if you're paying a 15% load and you're getting a 4% dividend yield, then after one, you're still down 11%, and you don't get high yield and a quality asset and low fees and everything. And so you really get like 2 out of 3 of those. And so like we're looking at buying high quality assets that are going to deliver yield and long-term total appreciation. But when you look at our deals, our yield may not be as high as other sponsors out there. It'll be in the range. We might be a 3, 3.5, 4, where you might be able to have a 3.5, 4, 4.5, or even 5. But don't fall for that, because that is sort of the bright and shiny, and the full picture is the total return and what it's going to be worth in 2, 3, 4, 5 years, and looking at it down the line.
Yep, good call. I got a question about QIs and timelines. If a client sold a building on May 20th, does the QI need to be set up at the date of realizing the sales proceeds? You would need to set up the QI before that. So if you had your closing date on the 20th, you'd want to set it up a few days before. If the closing, the client has taken possession of the proceeds, unfortunately, they can no longer do a 1031 exchange. But if they had a capital gain, they would be eligible for an opportunity zone fund. And opportunity zone funds can actually rescue some blown 1031 exchanges. So we'd be happy to chat about that if that would make sense.
Larry has a question. He has several DSTs, and his question is, can he roll those directly into the Income Plus Fund? And Larry, the answer is no, because that would require the Income Plus Fund to actually purchase those DST interests and take an interest then in that property. And so there's another stage. You would have to roll those DST interests into our DST program with, and then ultimately with the idea that that would roll into the Income Plus Fund.
Some more questions on the selling of the 721. If the 721 happens, the operating partnership units, can you 1031 exchange the operating partnership units? You cannot. So once you're in the operating partnership units, you no longer own real property, and so you don't have the ability to do an exchange further.
Jason asked the question. There's a lot of questions about this. I think conversion from DST to the 721, and then other optionality here. Are you allowed to exchange again out of this DST asset under similar guidelines as traditional 1031? The answer is no. This program is really for the person. It's the last stop in the life cycle of this investment. So you have a building, you no longer want to manage real estate, you want to be passive, that's it. If you're the person who wants to continue to swap and go into more 1031 exchanges, we can help you with that and advise you, but this program would not be for you.
Okay, and this question is from Kai. I'm glad you asked this question about debt. So basically saying, does the DST property have to match the leverage level of the asset being sold? It does not. You really don't have to match your debt. You have to roll over all of your proceeds, and you have to buy the same value, right? So the problem is, if you're paying off debt, you have $1 million property and you pay off $400,000, you have $600,000 in your pocket. How do you get back to $1 million? You only have two choices. You can add $400,000 of cash, or you can borrow it. So our DSTs will typically be levered, like I said, 45 to 50%. And so in that case, you would roll over $600,000. If our DST was levered at 50% LTV, you would assume the 50% leverage, and you would replace 1.2 million of real estate. So the leverage on the DST, which is non-recourse to you, will help you get to that replacement property value. And feel free to schedule a call. I could talk to you about it specifically.
Tim has a question. Does the fund currently exist? What has its performance been? Are its shares saleable? Tim, yes to all of the above. It does exist. We're talking about the Income Plus Fund that was launched in 2019. You can get information. You can either email me, or you can schedule a call with Mike. My email address is michael@origininvestments.com. And to anybody on the call today, you can always go to our website and just download the documents straight from our website, or look at the performance for the Income Plus Fund. But it's done extremely well, and I think it's a huge advantage of this program. And Mike talked about this earlier. You're dating the DST, you have to love the Income Plus Fund. And the Income Plus Fund, it's really designed to produce 9 to 11% annually with very little volatility and in a tax-efficient manner. So that fund has 3 strategies. We build, we buy, and we lend. So we utilize all of our strategies within one fund. And in fact, we just did a webinar on that a few weeks ago, which I highly recommend. If you're interested, you take a look at that webinar, because it really talks about where we're taking it over the next kind of 6-9 months, and even the next few years.
Yep, absolutely. And there's a couple other ones, some easy ones. Would industrial or retail property be qualified for like kind? Yes. I think I should have said my presentation that was not an exhaustive list. Those were just examples. So as long as it's real property held for investment purposes. So yes, any industrial or retail shopping centers, those would qualify for 1031 exchange. And then does an owner-occupied duplex work for an exchange? Actually a little bit trickier. Yeah, you could have two closings, or you could just carve out the owner portion. So you would just have to set that up with your real estate attorney, that the portion that you're selling, the tenant occupied portion, that's what you're going to be exchanging. You could also move out of the property and rent it to somebody for 2 years. Then you could sell the whole property and do a 1031 exchange. So that's a fun one. Feel free to set up a call if you want to talk about that specifically.
I love it. I just learned something new again. Look at that, owner-occupied duplex. Eric asked the question, will this product work for partial percentage ownership of third-party real estate syndication exits? No, it will not.
Okay, kind of the same question, but can you do a 1031 if I'm receiving proceeds from an existing syndication or fund of multiple properties? If that fund is a Delaware statutory trust, you can. And so if you're in one of those DSTs that we talked about, and that DST sponsor liquidates it and your proceeds come back to you, remember, you've got 45 days to identify. You just identify origin and go into one of our DSTs. So you could roll from DST to DST. Those are like kind, and that would work just fine.
Jerry asks, a $1 million deal and only $800,000 goes towards real estate. Is that a typical ratio? Jerry, it's a little wild west out there. It's all over the map. And this is an area where it's buyer beware. I've been shocked reading through the fine print of, dozens of private placement memorandums really getting down. And the key is really in the asterisks, and you dig down. And there was one deal, it was a $68 million raise, and the purchase price of the property was around $55 million. So that deal, in fact, was more than 20%. So if you put in $1 million, it would have been about $750,000. But, you have to almost be a sleuth and go through these things, and we've done this. And then there's some sponsors, though, that are much better. But you're always going to have your standard closing costs, your debt fees, things like that. And I think what we're talking about are the sponsor fees and the middleman fees and the broker and there's just so many. And Mike illustrated those earlier. But there's certainly, this is a market where not all sponsors are created equal. And I want to be clear, like there are some good sponsors out there. Not everybody, but one of the reasons why we're going into this market is because we believe that we have a better product, that we have a better team, that we can deliver a better service, that we're bypassing all of these middlemen along the way, and that your money will be better off here over the next 10 years than with anyone else out there.
Yeah, I'm trying to find new ones. Will there be an exchange fee going into the UPREIT? That's a good call. I've seen a lot of those in PPMs. We do not have one contemplated at this point. So you will roll into the Income Plus Fund with no disposition fee.
Kai asks, how many DST properties will you have initially for investors to exchange into? Kai, the answer is one at a time. So we're going to announce this property in the next 30 days. We'll come out with that. Once we get close to syndicating that, we hope to have another property right on its heels. Our deal team is looking for more properties as we speak. They're finding some very interesting opportunities in the marketplace today, but nothing that really fits the DST space, because you need something more stabilized that you can put a master lease on it. So some of the stuff we're seeing out there in this market falls along the kind of 95% completed construction, some distress, things of that nature. But that is the idea of just one after the other in sequential order.
Yeah, and so Carol asked, if the investor needs the capital in 15 to 20 years, is this a rational strategy? And I think so. Obviously, we can't give financial advice unless we know more about the client's particular situation and whether they would need it all. But at the end of the day, this would be taxable if you sell it. So remember, the way I like to frame that 721, 1031, no matter what solution that you're in, if you ever want access to your principal, you are paying taxes. So if you do a 1031 swap till you drop and you want your principal, you wait until it sells, then you keep the cash, then you pay taxes. And so this would be the same thing. So in 15 or 20 years, hopefully we would have grown that portfolio quite nicely. So maybe they could just pull the profit out of it depending on what their needs are. But yes, you can pull this cash out in 15 to 20 years and it would be, of course, taxable when you pull it out.
Cameron, I'm going to answer two questions, 20 and 21 here, Mike. Cameron asked, what is the life cycle of the Income Plus Fund? The Income Plus Fund is an open-ended fund, so it really doesn't have an end date. That means that we continually take capital. That fund has a number of properties in it. Today, it's around $500 million in total size, and we don't plan on shutting that down anytime soon. So it operates very differently than a closed-ended fund, and that's why it really is a perfect complement to the 1031 exchange platform we're launching. Nick asked the question, can capital gains other than real estate be used? No, Nick, unfortunately, no other capital gains can be used. If you do have capital gains, I encourage you to look into our QOZ program, because the QOZ is for capital gains for really anything other than real estate. And I will tell you that if you have a 1031 exchange opportunity, nothing is better than doing another 1031 exchange or a DST or program like this to defer taxes. But the next best thing to this is the cousin, which is qualified opportunity zones.
Okay, and I got a question from another Michael, Michael Koretsky. Basically, what's the process after you go under contract? So I talked about a lot of stuff, so let's just review. After you are under contract and you say, we're closing June 1st, well, it's too close. So let's say we're closing July 1st. You'd want to talk to a qualified intermediary sometime in June, and you get that account set up. It could be as quick as a 5-minute phone call. Then you go to closing, and the money has to go to that qualified intermediary at closing. From there, you have 45 days to complete the identification and roll the proceeds to us. But it could theoretically be much, much faster than that. Let's say, for example, our DST was out in the market during that time period and you liked it and you said, I know I want to invest in this. You could actually fill out all the paperwork in June, and all the paperwork we need. So we're now holding it for your investment. July 1, the money goes to the qualified intermediary. You ask the qualified intermediary to wire us the money on July 2nd. And so you'd actually be out of the market for 2 or 3 days, depending on how long the wires take. So it's actually a pretty simple process once you've decided to move forward. Michael, I see a lot about what circumstances might lead the Income Plus Fund to not make this acquisition. I think it's important that the Income Plus Fund has looked at and approved this asset. This is an asset that, as you mentioned, they looked at through their lens. Markets change. And so if we're talking about 2026, and maybe we have an over exposure to this particular geographic area, or maybe there's a better opportunity somewhere else, there is a potential that they would not exercise their right of first refusal there.
Yeah, I can't add much to that because this is a non-cash transaction. So even if the fund didn't have ample liquidity, it's really just an exchanging of shares. I suppose there could be, if the markets change, if the strategy changed, if suddenly we said, hey, we're no longer investing in Dallas for some reason, or Dallas we're just pausing and we have an asset in Dallas, that could be a reason. But I can't think of a good reason why the transaction wouldn't go through unless the strategy changed.
Yep.
So I think we've answered so many of these questions. They're coming in different forms, but sort of the same size and shape, and they all rhyme together. Let's see here. I think you've answered a lot of these, Mike. You see any more?
Yeah, your basis. I'm getting questions about basis. Basis rolls over into the DST, which rolls over into the operating partnership units. Good question. Can Origin act as a qualified intermediary? No, but we have great recommendations if you need one.
Kevin asked a question. This is a good question, Mike. I know the answer to one of these, but not the other. Are the upfront fees Origin charges a percentage of the LP's investment or the total enterprise value of the asset? The answer is that I know on the acquisition fee, it's the total enterprise value of the asset. The other one, which is an organizational and offering cost, is a reimbursement of 50 basis points up to 50 basis points. So these are actually legal costs, marketing costs, things that we expend. So it's not necessarily a fee, it's sort of an expense, but because it's listed as up to that number, we also put it on here. And Mike, I'm unclear whether that's a percentage of equity, that 50 to, I think it's 100 basis points, or a percentage of enterprise value on that one.
That's equity, the investment.
Okay. Yeah. So the acquisition fees are usually quoted in total enterprise value, and the other one is equity. Great question, Kevin. Thank you.
When can I identify if my money is already with a qualified intermediary? Give me a call, Darian, and we can. I can walk you through that. You can identify our property now.
Dave asks, are you still earning dividends prior to moving into the Income Plus Fund? Yes, Dave, you get all the benefits of being in that DST. You will earn any appreciation, any cash flow, anything, and that's all going to be spelled out in the PPM for the individual asset. And then Dima, excuse me if I didn't pronounce your name right, what is the minimum Origin DST investment amount? I believe, Mike, it's at $100,000, if I'm not mistaken. I'm not even sure that we've completely narrowed that down exactly. I know that, like when we're doing a deal that requires $35 million of equity, we can take anywhere from, call it $100,000 all the way up to $35 million. But that's the advantage. If you only have 100 or 200 or $300,000 in a 1031 exchange, you don't have enough cash to actually go out and buy a high quality asset. But you still may want to defer those taxes and invest in a program like this. And this gives you that flexibility.
Yeah. And here's a good one for you, Michael, since you're on the call. Britton is just asking, what is the long-term 20 to 30 years future of Origin? What is the end goal?
Wow, 20 to 30 years. I always tell people it's hard for me to see out 20 to 30 years. I'll be, 70, I'm 53 today, so that's between 73 and 83. Long term, we're built to last as an organization. Dave and I, from day one when we formed Origin, and I said earlier in the beginning that we didn't have this grand goal, but one thing we always felt strongly about is we didn't want it to be the Episcope and Shear show. That we actually started out with the name Origin Capital. We wanted to go beyond us and build something that can be sustained beyond just Dave and I. And so we've got a great leadership team behind us. We are a profitable company. We have a great balance sheet. We have a great partner in Covitz and Focus as well. So we're not going anywhere. And it really is a great question. And I know in this market, especially where you've had a lot of organizations that have not been doing well. Some of them, I know some of our competitors have actually folded shop. It's probably one of the most important questions that you can ask any manager if you're making an investment like this, because we get this question a lot in our QOZ funds, because QOZ, it's a minimum of 10 years. I'm invested in those funds. Dave is invested in those funds. And so we're not going anywhere as principals. And that's what I get. We're building a firm to last for the long term. There's nothing more that I'd love is to see the firm continuing on without me, whenever that is, right? And have the ability. So hopefully that answers your question.
Chender's asking, can someone invest cash into a DST and then when it goes up in value, roll that into the Income Plus Fund? We would just suggest that you roll it into the Income Plus Fund. And so that would avoid that whole sort of process, because if the Income Plus Fund goes up in value, there's no taxes due. There's only taxes due if you liquidate.
Derek asked about reporting. Would we see our DST holding in the same Origin portal we currently use? Absolutely. It'll be the same type of reporting that you're used to getting. It'll just be called something else.
Do the beneficiaries receive a stepped-up basis if the owner of the UPREIT dies? Yes, they would still receive a fully stepped-up cost basis, just like if you owned real estate.
Bill asked, this is a great question too. I never thought, can I consolidate multiple properties into one DST investment? And the answer is yes, you can. So Bill, if you have, if you're selling 4 or 5 properties and you put all those with a QI, you can put those into a single DST and solve all that challenge of owning it, managing it directly all at once. Let's see. Michael asked the question. I think I answered this for redemption schedule for the Income Plus Fund, 1 year lockout, and then it's declines each year, 10, 7.5, 5, 2.5 in that fund. And after 5 years, there's no redemption penalty.
So I have another question about debt. Basically saying, like, if you have, this is from Sharon, if you have a property that's fully paid off and you roll all of the cash, like you have to, into our DST, and our DST is 50% levered, are you actually buying twice the amount of real estate? The answer is yes. So you would have $1 million of equity, you'd have $2 million of real estate for the purposes of the exchange. You also get that basis. So let's just say, for example, your $1 million property all cash was fully depreciated and you had no basis. Because you're rolling into a deal with leverage at $1 million, you'd actually have $1 million of new basis, which you could then use to offset income. So you get the benefit of the leverage on the return as well as the cost basis.
And Mike, this question is from Bill, question 104. And I'm going to attempt to answer this. Bill, I'm going to caveat it by saying I'm not a tax expert. Mike knows much more about this than I do, but I will try. So we'll see how I do. Bill asks, once into the 721 and the original owner dies and it passes to family members, is that transfer value updated to current market so family does not have gain? There is a step up in basis upon death. And if that's true, does the family then have a chance to exit the 721 without a taxable event? I feel like I want to say, yes, that's true. Somewhere taxes are always due upon death, but that step up in basis means that you're resetting the basis. Mike, maybe you can opine because I'm not 100% sure there.
Yeah, you can never say 100% yes to these tax questions because the tax law is so particular to people. And so depending on the size of your estate, you could still have estate taxes due. If they had no estate taxes due, and let's just say if it's a very, very simple example, if that's what you're asking, and it was, $500,000 interest or something, and you held it for 20 years, and then after 20 years, it was worth $2 million. They would inherit a $2 million interest. The basis would become $2 million. And so if they liquidate it, there'd be no taxes due in that hypothetical example. Of course, not knowing if they have estate taxes or anything like that, but that's how it works from the securities law perspective.
Yeah, there's more layers to it, especially if you're dealing with a large sum of money. Let's see. Assuming things go well, do you expect to always have a DST to invest into? Selling an asset can take many months if we are building. The answer is it's our intention to always have a pipeline of deals. It doesn't do us any good. It doesn't do you any good if we have this period where we're not out finding good quality deals. And it depends on the market. We're not going to do a deal just for doing deal and force something. So I can tell you our team is out there right now. We know that we have this deal in June. We're going to probably close that in, call it end of July, August, around that time period. And we want to get the pipeline up and going. But it is absolutely our intention to have one after the other and keep this program going.
Okay, what are the size of your deals? I would say for the DST market, anywhere from 60 to $90 million, 200 plus units that are located in our target markets would be about an average deal size.
Mm-hmm. Derek asked another question. As we follow through with the 721 exchange, will we pay the same setup fee as a new Income Plus investor if we are already in the Income Plus fund? Derek, at this point, there are no setup or admin fees when those partnership units, when you're swapped in there. That's only for new investors getting in. So if you come through this program, even if you're not an existing investor, and you go into the DST and then the Income Plus fund buys that DST, it's just a swapping of partnership units at that time. There actually is no disposition fee either today on the DST either.
And Glenn was asking if all the Origin DSTs will qualify for a 721 and Income Plus fund. That is our intention at this point, is for the Income Plus fund to have that same option to acquire all of our DSTs through a 721.
Yeah, the only caveat I'll say is if this program is so successful that we have, dozens and dozens of deals, at some point it doesn't make sense for the Income Plus Fund to acquire them anymore, because the Income Plus Fund has a strategy, and that fund is tactically managed. So we're talking about in the future. It's not a problem today doing 3, 4, 5 deals a year, because that fund needs exposure to different markets. It needs cash flow. It needs common equity in that fund as well. But if it got so big that all that fund we're in the business of buying our DST assets, we wouldn't do that anymore. And we would open up a brand new specialized fund that would only be for rolling these assets in. But for the foreseeable future, it's the Income Plus Fund that has the right of first refusal. And you will know that on each and every deal. The deal we're going to announce in June, we will talk about that on the webinar, that the Income Plus Fund has that right of first refusal. If that ever changes, we will announce that.
Okay, I'm having trouble kind of finding new questions.
Yeah. Okay. I think we've answered a lot of them. Okay, is that it, Mike?
Yeah, I'm having trouble finding any new ones, but
okay.
I do have a lot in here of people saying, hey, I've got my money as a qualified intermediary. I've got an exchange coming up. Feel free to use my booking link or just email me directly, and happy to chat.
Yeah, and thank you, everybody, for hanging in there this whole time. We're an hour 23 into the webinar. We're going to cut it off right now. You have, certainly, you're able to book a call with Mike. Please take him up with that. On that, if you want to get in touch with me, my email address is michael@origininvestments.com. And we thank you for listening today, for tuning in, for being a valued investment partner. And please reach out to us anytime. Thank you.